My dear students, welcome back to our channel. Students, in this video I am explaining MBA third semester. Subject Investment and Portfolio Management, third unit. Important short and long questions and answers. Let's start quick revision. First important short question is bond indenture. A bond indenture is a legal contract between a bond issuer and bondholders, outlining the terms and conditions of the bond. It includes details such as the bond's interest rate, maturity date, payment schedule, covenants, restrictions or obligations of the issuer, and the rights of bondholders. The indenture protects the interests of both parties by specifying actions in case of default and other contingencies. It ensures transparency and helps bondholders understand the risks associated with their investment while providing a framework for resolving disputes. Next important short question is YTM, AYTM and YTC. YTM, yield to maturity, is the total return an investor can expect if a bond is held until its maturity date. It includes the bond's current market price, coupon, payments, and the time to maturity. YTM assumes the bond is held to maturity and that all interest payments are reinvested at the same rate, giving a comprehensive measure of a bond's return. AYTM, average yield to maturity, is the average YTM of a portfolio of bonds. Since individual bonds may have different coupon rates, prices, and maturities, AYTM provides an overall measure of return across a group of bonds, reflecting the weighted average of their YTMs. YTC, yield to call, is relevant for callable bonds, which can be redeemed by the issuer before maturity, usually if interest rates fall. YTC calculates the return, assuming the bond is called at the earliest possible date instead of being held to maturity. This yield is important for investors as it accounts for the potential early redemption, which may limit the bond's overall return if the issuer chooses to call it. In summary, YTM reflects long-term returns. AYTM averages returns across a portfolio, and YTC considers early bond redemption scenarios. Next important short question is bond convexity. Bond convexity refers to the measure of the curvature in the relationship between a bond's price and its yield. It captures how the duration of a bond changes as interest rates change. Higher convexity indicates that a bond's price increases more for a decrease in yields than it decreases for an increase in yields, making it less sensitive to interest rate changes. Bonds with greater convexity are considered less risky because they experience smaller price declines when interest rates rise. Convexity helps investors assess the risk and potential price movement of a bond. First important long question is factors affecting bond yield. Bond yield is the return an investor can expect to earn from holding a bond, and it is influenced by a variety of factors. These factors include interest rates, inflation expectations, credit risk, market liquidity, and economic conditions. 1. Interest rates. The most significant factor affecting bond yield is the relationship between bond prices and interest rates. When interest rates rise, bond prices fall, which increases bond yields. This is because new bonds issued at higher rates make existing bonds with lower rates less attractive, thus decreasing their price and increasing their yield. Conversely, when interest rates fall, bond prices rise and yields decrease. 2. Inflation expectations. If investors expect higher inflation in the future, they will demand higher yields on bonds to compensate for the eroding purchasing power of future interest payments. Inflation causes the real value of bond returns to decline, so higher inflation expectations typically lead to higher yields. On the other hand, if inflation expectations are low, bond yields tend to be lower as well. 3. Credit risk. The creditworthiness of the issuer is another key factor. Bonds issued by governments or corporations with higher credit risk require higher yields to attract investors. Investors need to be compensated for the risk of default. Bonds from highly rated issuers, like government bonds of stable economies, generally offer lower yields, while bonds from issuers with lower credit ratings, such as junk bonds, offer higher yields to account for the risk. 4. Market liquidity. The ease with which a bond can be bought or sold on the secondary market also impacts its yield. Bonds that are more liquid tend to have lower yields because investors are willing to accept lower returns for the ability to quickly sell the bond. Less liquid bonds often offer higher yields to attract investors. 5. Economic conditions. The overall health of the economy influences bond yields. In times of economic expansion, yields typically rise due to higher demand for capital and expectations of rising inflation. Conversely, during periods of economic downturn, yields tend to fall as demand for safer, lower-risk investments increases. In summary, bond yields are shaped by a complex interplay of interest rates, inflation, credit risk, liquidity, and economic conditions, all of which help investors determine the returns they expect from bonds. Next important long question is: explain the bond price theorems with examples. Bond price theories help explain how bond prices are determined and how they respond to changes in economic factors like interest rates, time to maturity, and coupon rates. Two key bond price theorems are the interest rate risk theorem and the coupon rate theorem. 1. Interest rate risk theorem. This theory explains the inverse relationship between bond prices and interest rates. When interest rates rise, bond prices fall, and when interest rates fall, bond prices rise. This happens because the fixed interest payments, coupons, become less attractive when new bonds offer higher rates, causing the price of existing bonds to drop. Conversely, if interest rates fall, existing bonds with higher coupon rates become more attractive, increasing their price. Example: consider a bond with a 5% coupon rate and a 10-year maturity. If market interest rates increase to 6%, the bond's price will fall as new bonds offer a higher return. On the other hand, if market interest rates fall to 4%, the bond's price will rise as its 5% coupon becomes more attractive relative to new bonds. 2. Coupon rate theorem. This theorem states that bonds with higher coupon rates tend to be less sensitive to changes in interest rates compared to bonds with lower coupon rates. Bonds with lower coupons have higher duration, meaning they are more sensitive to interest rate changes and experience more significant price fluctuations. Example: a 10-year bond with a 7% coupon rate will typically have a lower price volatility than a 10-year bond with a 3% coupon rate, assuming both are priced at par. The higher coupon bond pays more frequent interest payments, making it less affected by changes in interest rates. In addition, duration, a measure of a bond's sensitivity to interest rate changes, plays a critical role in bond price behavior. Longer maturity bonds and bonds with lower coupons have higher durations and, thus, are more sensitive to interest rate changes. In conclusion, bond prices are influenced by changes in interest rates and coupon rates. The interest rate risk theorem highlights the inverse relationship between bond prices and rates, while the coupon rate theorem explains how bonds with higher coupon rates are less affected by rate changes. Next important long question is: calculate the duration for bond A and B with 7% and 8% coupons having maturity period of 4 years. The face value is 1000 rupees. Both the bonds are currently yielding 6%. To calculate the duration of bonds, we can use the Macaulay duration formula, where TT is equal to time period in years. Given face value FVFV is equal to 1000 rupees. Step 1. Calculate the price of bond A and bond B. For bond A, 7% coupon rate coupon payment CC is equal to 7% of 1000 is equal to 70 rupees. The price of bond A, PAP_A, is the present value of all future cash flows. Coupons and face value discounted at the YTM of 6%. For bond B, 8% coupon rate coupon payment CC is equal to 8% of 1000 is equal to 80 rupees. The price of bond B, PBP_B, is calculated similarly. Step 2. Calculate the duration of bond A and bond B. Now we can calculate the duration for both bonds using the formula. For bond A, 7% coupon rate. For bond B, 8% coupon rate. Conclusion. Duration of bond A, 7% coupon rate, 3.63 years. Duration of bond B, 8% coupon rate, 3.59 years. These results show that both bonds have relatively similar durations, with bond A, the 7% coupon bond, having a slightly longer duration due to its lower coupon rate. Next important long question is: determine Macaulay's duration of a bond which has a face value of rupees 1008% annual coupon rate and 4 years to go for maturity. The bond's YTM is 10%. To calculate the Macaulay duration, we use the following formula, where TT is equal to time period in years. Given face value FVFV is equal to 1000 rupees. Step 1. Calculate the annual coupon payment. The annual coupon payment CC is calculated as: Step 2. Calculate the bond price, present value. The price of the bond, PP, is the present value of all future cash flows, coupons, and face value, discounted at the YTM of 10%. Calculating each term. So, the price of the bond, PP, is approximately 937 rupees and 45 paise. Step 3. Calculate the duration. Now, we use the Macaulay duration formula. Breaking it down. Conclusion. The Macaulay duration of the bond is approximately 3.56 years. Next important long question is: calculate the Macaulay's duration of a 3-year bond that has par value of 1000 rupees with a coupon rate of 5% and a YTM of 6% also. Calculate the modified duration. To calculate the Macaulay duration and modified duration, we will follow the necessary formulas and steps. Given face value FV is equal to 1000 rupees. Coupon rate is equal to 5%. Step 1. Calculate the price of the bond present value. The bond price is the sum of the present values of all future cash flows, coupons, and face value, discounted at the YTM of 6%. Breaking this down. So, the price of the bond, PP, is approximately 971 rupees and 66 paise. Step 2. Calculate Macaulay duration. The Macaulay duration formula is where TT is equal to time period in years. Now, we calculate the weighted present value of each cash flow. Breaking this down. So, the Macaulay duration of the bond is approximately 2.86 years. Step 3. Calculate modified duration. The modified duration is calculated using the formula, substituting the values. Conclusion. Macaulay duration is equal to 2.86 years. Modified duration is equal to 2.69 years. The Macaulay duration represents the weighted average time until cash flows are received, while the modified duration shows the bond's price sensitivity to interest rate changes. Next important long question is active and passive bond portfolio management strategies. Active and passive bond portfolio management strategies are two contrasting approaches to managing bond investments, each with its own objectives, methodologies, and risk profiles. Active bond portfolio management. In an active bond portfolio management strategy, the manager seeks to outperform a benchmark index, such as a bond market index, by making strategic decisions based on interest rate forecasts, economic conditions, and bond selection. Active managers aim to capitalize on market inefficiencies, mispriced bonds, and fluctuations in interest rates to generate higher returns than the overall market. Key elements of active management include interest rate predictions. Managers forecast future interest rate movements and adjust the portfolio's duration accordingly. If interest rates are expected to decline, the manager may lengthen the portfolio's duration to benefit from price increases. Credit analysis. Active managers evaluate individual bonds for credit quality. By buying undervalued bonds or selling overvalued ones, they aim to improve returns. Tactical asset allocation. Active managers can adjust the portfolios sector allocation or bond types, example, government versus corporate, based on market conditions and trends. Example, if a bond manager believes interest rates will fall, they may extend the duration of the portfolio by purchasing long-term bonds, anticipating price appreciation. Passive bond portfolio management. In contrast, passive bond portfolio management seeks to replicate the performance of a specific bond index rather than trying to outperform it. The objective is to match the risk and return of the benchmark by holding a broad and diversified set of bonds. This approach is less hands-on and typically incurs lower costs due to minimal trading activity. Key characteristics of passive management. Index tracking. The portfolio is constructed to mirror the composition of a chosen index, such as the Bloomberg Barclays US Aggregate Bond Index. Low turnover. Passive managers make few adjustments to the portfolio, focusing on maintaining the index's structure. Reduced costs. Since the portfolio is not actively managed, fees are lower, and there's less need for frequent trading. Example, a passive bond strategy would involve investing in an ETF that tracks a bond index, providing diversified exposure to the bond market without trying to predict market movements. Conclusion. Active bond portfolio management offers the potential for higher returns through strategic decisions, but with higher risks and costs. Passive management, on the other hand, offers lower costs and reduced risk by closely tracking an index, making it a more conservative and less labor-intensive approach. Students, for other units explanation and other subjects quick revision or explanation links are available in description. Check out once. I think it will be useful to you. Thank you. Thank you for watching. Like and share this video with your friends.